This video is for educational purposes only and should not be considered financial advice. You could be profitable after this video. If there's one trading video that you should watch, it is this one. What we are about to share with you in this video is the magic key that will fix mostly any mistakes in your trading and make you a profitable trader if you implement it correctly. The mitigation block. This magic key we are referring to is the mitigation block. This often overlooked concept of ICT is really the key to your success in trading. Let's look and see what a mitigation block actually is. A bearish mitigation block is a high, a low, and a higher high. As we see in this example, there is a high, a low, and then a higher high. We draw a line out to where that second higher high starts, and that's our bearish mitigation block. In this example, we see a bullish mitigation block, a low, a high, and a lower low. So right here is our low, then we have a high, and then a lower low. We draw a line out for the bullish mitigation block. Let's look at how we can use these in our trading to refine our trades and become more profitable. One of the best ways to use mitigation blocks on their own is to use a higher time frame to find a setup and then use the lower time frame for your entry. Look on an hourly chart for a mitigation block, and once price reaches it, wait for another mitigation block in the same direction and enter the trade on a smaller time frame. Your stop loss will be behind the mitigation block and your take profit will be at the opposing mitigation block. So here we have our hourly chart, and we see there's a bearish mitigation block up here, and then we have down here a bullish mitigation block. There is also a second bullish mitigation block down here. So when price blows past this mitigation block and goes all the way up to this one, now we're looking for a trade off of this bullish mitigation block. And our opposite trade will be this bearish mitigation block. Now, as we see, price continues up and it actually hits this bullish mitigation block that we have not marked out. So this is a high, a low, and a higher high. If we draw the line out, it actually touches right there and goes back to this bullish mitigation block. So that is another trade that you could have taken on a smaller time frame. But once we see this trade hit right here, this is where we want to enter on a smaller time frame. And then our next exit, our TP, will be at this bearish mitigation block, because as you see, there are no more mitigation blocks in the way on its way up to this mitigation block. So this is that trade on a smaller time frame. We see price has moved up and then it touched that other bearish mitigation block. It came down, then it touched into the mitigation block at this level. What we're looking for on this smaller time frame, this 5-minute chart, is another mitigation block. Here we have a low, a high, and a lower low. This is also another one, a low, a high, and a lower low. There's also one inside of here. So when price comes back to this level, after it breaks structure, it comes back right here. That is an entry. Your stop loss is below the lower low. Price takes off and it goes all the way up to that bearish mitigation block and beyond. Let's take a look at how you can use mitigation blocks with another strategy we covered in our video series. One strategy that we covered in our video series is using the RSI indicator for entries. You can look for divergence in the RSI indicator for potential trade setups. You can also use trendline breaks on the RSI indicator. What we will be looking for are mitigation blocks that provide a suitable entry when we see either of these RSI indicator setups. Here we have both a divergence and a trendline break, along with the mitigation block. We have a trend line established on this 5-minute chart. We have a divergence between this price movement and the RSI. We also drew a trend line break down here And we see that happen before the actual trend line break on price action. On the RSI, the trend line break occurs early. Then we're looking for an entry, which is here, where price goes back up into this fair value gap and touches the bottom of this mitigation block. We have a high, a low, and a higher high. That's our mitigation block. So when price touches this level, we can take an entry. And as we see, price continues to the downside to take out this liquidity. Here's a bullish mitigation block with the RSI. We see divergence here and here. Then we see a trend line break. And if we look, this is a low, a high, and a lower low. And price breaks that structure, comes back to it, and you could enter here. But if you did, you would have to put your stop loss all the way behind here. And that's not a good risk to reward. So what you want to do is wait for price to go back deeper into this order block, probably around 50%, which is where this is. It's also retouching that trend line, and that's your entry. Then price shoots up to the upside. In this example, on a 15-minute chart, we see price has dipped into this bullish mitigation block. We have a low, a high, and a lower low, and price taps right on the top of the beginning of the mitigation block. And that's what you're going to watch for. Sometimes price will dip to the lower low, but if you see price reacting from this bullish mitigation block, then you want to start looking to enter your trade. And as you see, we wait till price continues upward and breaks this lower low right here. We have a low, a high, and a lower low. Now, what you could also do is wait till price breaks this structure, which it does here. Then it retraces right back in to that lower low. And that's the more conservative entry that is lower risk to reward. And you have your move to the upside for your 2-to-1. And you also have divergence on the RSI. In this last example, we see a trend line break, divergence, and we have a high, a low, and a higher high. Price breaks that structure, comes right back in to touch the bottom of that mitigation block. And again, what we're looking for is the price action to touch the higher high. Well, in this case, the higher high starts lower than the original high. So that is a good entry, putting your stop loss above the higher high, and then price shoots down past this area of liquidity. Now you'll also find multiple mitigation blocks. So right here you have a high, a low, and a higher high. And then this is a high, a low, and a higher high. So you have 2 mitigation blocks in one. And what you want to do is take your entry from the first one that price returns to. And that's your move to the downside. To recap, mitigation blocks are the key to success in trading ICT. You can literally pair them with any strategy and they will make the strategy profitable. The key, however, is when implementing mitigation blocks with other strategies, make sure there is enough room until the opposing mitigation block for profit to be made. You should also make sure you are on the right side of market sentiment. You can tell that you are on the right side when you see mitigation blocks getting respected on the smaller time frames. If you found this video helpful, please like and subscribe for more videos like these. Also, please leave a comment if you have any questions or if you have any other video suggestions. Thank you for watching.